Hello and welcome to FT Markets. The subject today are credit markets, who have experienced one of their worst months in years, since 2009 in fact. So how should we think about the outlook, the prospect for credit markets, for credit investors, and what's going to happen next? To help us think through some of these issues, we're joined by Philippe Berthelot, Head of Credit for Natixis Asset Management. Hello, Philippe.
Hello.
So perhaps you could set the scene for us. Where are we in terms of sort of the credit world overall at the moment?
We'd like to explain the fact that we've witnessed some overshooting in September, as you've mentioned. Probably one of the worst months for credit markets in the last 4 years. On top of that, 2015 is posting negative return for investment grade, the very first time since 2008. Then you could say, well, is it the end for credit markets in general? I think the result in September is a combination of two different set of factors. The first one is risk aversion, and we'll see that depicted on a graph at a later stage. And I would say a combined syndrome of Volkswagen and Glencore to some extent. This is why we think that we've witnessed a substantial rise of risk aversion. Let's say it's a sentiment-driven factor, whereas the fundamentals in credit markets in Europe have stayed quite good, quite healthy.
And I think one of the things that sort of people have said to me about credit is what you saw with Volkswagen and Glencore was, whereas before investors would have just bought on those big moves that you saw, now they're a bit more nervous, and so they're not willing to step in the same way that they were. And I think you've got a chart here which shows, this is a proprietary chart of risk aversion. Maybe you could tell us how it's put together.
Exactly. It's, you know, markets from time to time are not that rational from time to time. And this is why it's good to have, you know, a sentiment perception or risk perception index. This is a combination of different features, equity volatility, emerging spread, equity volatility. And you have to be contrarian. When you are at the top, you should buy because everybody is scared to death. When you are at the bottom, everybody feels comfortable, happy to live. This is perhaps the time for selling. And this is exactly where we're here, around 80, the 80 threshold. And we were at, you know, at the end of August, where suddenly two crises occurred. The question mark about the Chinese economic activity and the Greece crisis, another one. And since then, this risk perception has stopped and was for us perhaps an indication that the market was overshooting. But definitely, this is something we need to take into account in our investment process.
So if the market has overshot, I mean, what are you looking at in terms of the key things for the outlook and sort of where you would be allocating money now?
Definitely, one key support for credit markets, despite the overshooting, has been very low level of default. The default rate in Europe is low, as in the US. And by the way, we're expecting some divergent path there with a softer default rate path for Europe versus the US. Why that? In the US, 13% of the high-yield sector is made of energy. And we still have bad news to come from the shale gas producer. With the whole price collapsing, halving year to date, you may have some defaults to come. For instance, in April and May, half of the defaults in the US came from the energy sector. This is why we do expect 2% default rates in Europe versus 3 to 4% in the US. Key support is default rate. That said, it's still very low, below historical average. Historical average of default rates in Europe or in the US has been between 4 and 5. Then this is quite good. A very key element for us is definitely technicals.
And I think we've got another chart here of the technicals.
Exactly. One key support of credit markets in the last 4 years, from 11 to 14 to a lesser extent, has been negative net supply. You had more redemption and coupon payment than issuance. But that said, even if net supply is getting positive, with more than 128 billion year to date, it's far less in terms of number versus 2004, 5, or 6. And you know what? Beyond this figure, which is a bit less supportive because you have a scarcity premium fading through our asset class. That said, you know, a big part of that number is coming from Yankee bonds. A lot of American issuers, Apple, Merck, McDonald's, 1/3 of European credit market issuances have been made by US corporates. And it was a surprise. It has given more extra supply than expected. It has weighed a bit on prices. That said, it's welcome. Why that? Because they trust the euro currency.
Oh, so all in all, a positive sign for credit?
It's a positive sign. We are living in a more difficult year. It's a bumpier and bumpier for credit. I think it's linked to risk aversion, equity volatility, impacting the trade markets. But nevertheless, when you look at free cash flow generation, default rates, you have more deleveraging than releveraging in Europe. Technical is a bit muted, but valuation-wise, well, it's still very quite cheap. Trade markets, in our eyes, are cheap in nowadays pricing.
Great. Well, thank you very much for joining us, Philippe. So it looks like a lot of nerves are in the market. Perhaps credit is cheap after all.